Hey everyone, and welcome back to the channel. Today, we're diving into one of the most exciting and potentially profitable trading strategies out there, breakouts. Have you ever seen a stock just sitting there, not doing much, and then suddenly it shoots up like a rocket? That's often a breakout, and if you know how to spot them, you can ride that wave of momentum. So, if you're ready to learn how to catch these powerful moves, stick around. First, let's get the basics down. What exactly is a breakout? In simple terms, a breakout happens when a security's price moves above a resistance level or below a support level. Think of these levels as invisible ceilings and floors. The price bounces between them for a while in what we call a consolidation phase. It's like a coiled spring, building up energy. The breakout is when that spring finally releases. The key sign that a breakout is gaining traction is a significant increase in volume. High volume confirms that there's real conviction behind the move and it's not just a fake out. So, how do we find these potential breakout opportunities? It all starts with chart patterns. These patterns are visual representations of the battle between buyers and sellers. Classic patterns like triangles, flags, pennants, and the famous cup and handle, all signs of consolidation that often precede a big move. For example, in an ascending triangle, you see a flat resistance line at the top and a rising trend line of higher lows at the bottom. This shows buyers are getting more aggressive, pushing the price up against that ceiling. When the price finally breaks through that resistance, it's your signal that the bulls have won and a new uptrend might be starting. Let's talk about the cup and handle pattern, a personal favorite of mine. It looks just like its name suggests, a U-shaped cup followed by a smaller, slight downward drift called the handle. The cup forms after an advance and looks like a bull or rounding bottom. The handle is a short pullback that represents the final period of consolidation before the big move. The breakout occurs when the price moves above the resistance line formed by the top of the handle. This pattern is a powerful bullish signal, and when you see it forming on your chart, you should definitely pay close attention. Now, spotting the pattern is one thing, but timing your entry is crucial. You don't want to jump in too early and get caught in a fake out, where the price briefly pokes through the resistance only to fall back down. A common strategy is to wait for the candle to close above the resistance level. This gives you more confirmation that the breakout is genuine. For more conservative traders, you might even wait for a retest. A retest is when the price breaks out, then pulls back to touch the old resistance level, which now acts as a new support level. If it bounces off this new support and continues upward, that's an extremely strong confirmation to enter the trade. Volume is your best friend when confirming a breakout. A true breakout should be accompanied by a spike in trading volume, ideally at least 50% higher than the average volume. Why is this so important? Because it shows that large institutional investors, the big money, are participating in the move. If a price breaks out on low volume, be very skeptical. It's often a trap set to lure in unsuspecting retail traders before the price reverses. So, always keep an eye on that volume indicator at the bottom of your chart. It can save you from a lot of failed trades. Once you're in a trade, managing it is just as important as entering it. This is where you need to have a plan for taking profits and cutting losses. A common way to set a stop loss is to place it just below the breakout level, or below the low of the breakout candle. This ensures that if the trade turns against you, your losses are limited. As for profit targets, you can use the height of the consolidation pattern to project a potential price target. For example, with a rectangle pattern, you would measure the distance between the support and resistance levels and add that amount to the breakout point to get a target. Let's be real, not every breakout will lead to a massive rally. The market is unpredictable, and fake outs are a part of the game. That's why risk management is non-negotiable. Never risk more than a small percentage of your trading capital on a single trade, typically 1 to 2%. By doing this, you can withstand a series of losses without blowing up your account. Remember, trading is a marathon, not a sprint. The goal is to stay in the game long enough for your winning trades to compound and grow your account over time. Consistency and discipline are your greatest assets. To recap, the key to successfully trading breakouts is a multi-step process. First, identify a clear consolidation pattern on the chart. Second, wait for the price to break through a key support or resistance level. Third, and this is crucial, confirm the breakout with a significant increase in volume. Fourth, enter the trade with a clear plan, including your entry point, your stop loss, and your profit target. And finally, manage your risk diligently on every single trade. It might sound like a lot, but with practice, this process will become second nature. Thank you so much for watching. I hope this breakdown of breakout strategies helps you become a more confident and profitable trader. If you found this video helpful, do me a huge favor and hit that like button, and make sure you're subscribed with notifications turned on so you don't miss our next video. Got any questions or want to share your own breakout trading experiences? Drop a comment below. I love hearing from you all. Until next time, trade smart and trade safe.